Hello, everybody, and welcome. My name is Matt Myrick, and I'm a certified financial planner. And I'm pleased to announce a guest here today, Tony Doran, who is a CPA and owner of Doran Tax Advisory and Preparation. And so today, Tony and I are going to collaborate on a case study with a high-earning family making $300,000 a year, a scenario that one spouse is working outside the home, the other one is staying at home. They live in a high income tax state like Minnesota, and we want to walk through both a basic and then an advanced strategy to help them minimize taxes and also hopefully build wealth for the future. So let's dive into the case study. So we have a married couple, and they're 52 years old, and they're making $300,000 a year. Now they're W-2 income, which means that they're not business owners. They work for a company, and they're receiving a paycheck, maybe a salary. And one of the challenges is when you work for a corporation, you don't have as many options for deductions as you would maybe if you're a business owner. And so become limited, and then you feel like you're just bleeding taxes. So here's a common scenario. So you make $300,000 a year, and get a standard deduction of $30,000. Federal and state taxes might be about $69,000 if you did nothing to reduce them. Okay, so that's kind of our base case scenario, right? Now, most employers are going to offer something like a 401k plan. If this employee is over 50 years old, they can use the catch-up provision, and so you're looking at $30,500 that they could put into a traditional 401k account. That'd be deductible, so that's great. Then, in addition, and this is becoming more well known, but want to make sure that we talk about the HSA. A lot of times through your benefits through your employer, you're going to have the ability to choose a higher deductible healthcare plan and making you eligible for using an HSA. We love to see people do that. That could be another $8,300 that you could put into that if you're using the family plan. Then there's always charitable contributions, right? You could donate to your church, or you could even invest in a donor advised fund. Let's just, in our case, say here that was $15,000 going into that. Then if you factor in after these, we'll call them low-hanging fruit, kind of taking the available accounts to you under most employer plans in most situations, you're now looking at about $58,000 of taxes owed. So kind of, the more basic, straightforward planning gets you $11,000 of deduction. So that's, or $11,000 less taxes owed for the year. So that's fantastic. But you might be watching this video and thinking to yourself, okay, I already knew that, I'm already doing it, but I still have a really hefty tax bill. What else is there out there? And that's where I want to bring Tony into the picture.
Yeah, thanks, Matt. I appreciate being on the show and getting the opportunity to talk about this today. So yeah, as Matt just clearly laid out, if you're a higher income earner, making $300,000, you're likely already taking advantage of the things he talked about: 401k, HSA, some charitable giving. And then in this example, if you're over 50, you're probably doing the catch-up 401k, which would be, $30,500 this year instead of $23,500. So yeah, given all that, if you were under 50 and just doing $23,500, you would, save about $11,000 in taxes. If you got the catch up, so another $7,000, it might be closer to $12,000. So not huge, but regardless, that'd be $12,000 approximately in tax savings. So certainly nice, but you're likely already have heard about all that, and you're likely doing all those things if you're making that sort of income. So then, you're kind of left like, well, is there any tax advisor, financial advisor who can kind of help me plan on saving more? And something that's becoming more popular and can be a great strategy if you're a higher income W-2 earner is investing in rental property. And traditional rental property won't help you as much. Think long-term rental where you get a tenant who signs to a longer term lease. That's passive activity. So if your income exceeds $150,000 in taxable income, you phase out, so you can't take those passive losses from the rental property and lower your W-2 wages unless you're a real estate professional. And since a lot of us aren't real estate professionals, we're kind of coming back to, well, okay, what are some ways we can lower our already high taxable income? And so the real estate opportunity is short-term rentals. And so you think your VRBOs, your Airbnbs. And so how this works is if you have a short-term rental and you materially participate in that activity, you can take these losses, and I'll get to in a moment how we can create some larger losses, at least on paper, for the tax return to lower your income. But there's two criteria you need to check off. Number one is it needs to be a short-term rental, which means the average stay over the course of the year of your guests needs to be 7 days or less. So easy math. If you had two guests during the year and they stayed a combined 13 days, the average stay is 6.5 days. Check, you would meet that 7 days or less criteria. The second one is called material participation, and the IRS has 7 rules for how you can materially participate. For the sake of this video, I won't go through all 7. I would say the most common ones are you spend 500 hours during the year participating in that activity. Otherwise, the other one, which is my favorite, is you spend 100 hours during the taxable year working on the property or any activity involved with that property, and it's more time than any other individual. And a key thing to point out is when we're talking about an individual spending 100 hours on the property, this would include both spouses if it's a married couple. So one of the spouses could spend 80 hours, the other spends 20, but in total they're in 100 hours. And as long as there was no other person, a cleaner, a contractor, anyone else working on that property, as long as no one else spent more time than them, they would qualify for material participation. So this can oftentimes be a really good strategy in the first year that you buy the short-term rental, because the first year you buy a property, I don't think it's unrealistic for a married couple to spend 100 hours, going out to the property, placing with furniture. Maybe there's some painting or just minor repairs, or maybe even major repairs you have to get ready to do before you can start renting out this property. So if combined, they can spend 100 hours and maybe be more materially participate in that first year, they can qualify for the short-term rental loophole. And so what that means is if there are losses on the tax return related to this property, they could offset their taxable income. It's no longer considered passive. It's an active loss at this point. That is the loophole, so to speak. So it's probably best to look at an example as far as, okay, what might this look like? So let's say this couple purchases a $500,000 home and they're going to rent it out as a short-term rental. If it's a typical short-term rental property, you can depreciate the building value over 39.5 years. So if it's $500,000 property, and you did straight line depreciation, that would give you 12 or 13,000 in depreciation. So that's not bad. But if you can do a cost segregation study, which a team of people would then come out and they would basically segregate your property into smaller life assets, what this can do is create, let's say 20% of that property now is considered assets that have a life of 20 years or less. Then you can take bonus depreciation and depreciate 100% of those shorter life assets in the first year. And so what that might mean, let's say 20% of the property now has a taxable life of 20 years or less. Now you're doing depreciation of 100,000 as opposed to 13,000. So a huge depreciation deduction, which oftentimes would at that point create a loss. So knowing that, let's look at a realistic example. So let's say it's year one, you on average book $5,000 in rental income at this Airbnb for 12 months. So you've got 60,000 in rental income. You're likely going to have a property manager who, maybe takes 20% of that gross income in property management fees. So that's 12,000. Let's assume a 6% loan, and you likely had to put 20% down because it's an investment property. So you've got about 24,000 in mortgage interest. Property taxes, let's say, are 6,000, insurance 2,000, utilities and cleaning supplies combine about 10,000. So kind of going through those numbers, which are pretty reasonable for a property of this type, you would have total expenses before depreciation of 54,000. So 60,000 in rental income, 54,000 in expenses. You've got a $6,000 profit. But then if you just take regular depreciation, let's call it 12,000, you create a $6,000 loss. Not bad. And if you materially participate, and this is a short-term rental, you can take that 6,000 and lower your tax bill. Great. But the reason we wanted to do a cost segregation study is we can really accelerate the depreciation here. So we just did another 100,000 in depreciation. So now you go from a $6,000 loss to, let's call it $106,000 loss. And again, I believe this to be conservative. This is assuming a 20% increase in depreciation off of the property value. I would say a lot of people, estimate you can get quite a bit higher than that, maybe 30-40%, just depending on the property. So then if we kind of go back to our numbers for the example, if we were able to reduce our taxable income another $106,000, we go from, having taxable income of, 200 and let's call it 30,000 to 130,000. So then in this example, the total tax we would pay now for federal and state is about 27,000, which means just by doing this cost segregation study and investing in a short-term rental, you went from saving $29,000 if you were already doing, the typical 401k, HSA, and that sort of traditional tax planning. So by doing this, you just saved another $29,000 in taxes. And then if you weren't doing anything before, it's an additional $42,000 in tax savings. So you likely would get a bulk of this back in refunds, which would maybe open the door for you continuing to invest in short-term rentals, or at a minimum, you can deploy that into making the rental a better property where you can charge higher rent in future years. So that's some of the power of the short-term rental loophole.
Tony, thanks for walking us through that. So just to recap, $300,000 income before any type of efforts to reduce your taxable income, you'll be looking at $69,000 of taxes owed. After you take the low-hanging fruit 401k, HSA, some charitable contributions, might be lowering that to $58,000, $57,000. And then if you were to do a short-term rental property and then you do the cost segregation study, you could be looking at potentially $27,000 of taxes owed, which is a significant amount of money that's back in your pocket. And so this is just a really great case study example of where a financial advisor and an accountant can work together to collaborate and help you, build wealth for the future and also minimize taxes, even if you are a W-2 employee. So I hope this was helpful. Please do subscribe to our YouTube channel. And also there's both information to my company, Stewardship Investments, and then Tony's Doran Tax Advisory and Preparation at the bottom. Tony and I would love to speak with you. God bless you. Take care.